and welcome to the first installment of Anders' 2026 Banking Webinar Series. And we're so happy to have you with us. For those of you who are new to us, a very, very special welcome. We do these on about a quarterly basis, so please spread the word. We'd appreciate that. My name is Brad Stumpe. I'm a partner and the practice leader for bank compliance and loan review here at Anders. You'll notice there's nothing about accounting in my title, which is why I'll be joined today by Jon Waitukaitis. Jon is an audit partner and the leader of our financial institution practice. He's been with the firm for, I think, over 20 years now. I'll let him correct me if I'm wrong on that. And he was a great help to me when we merged into Anders back in 2020. I'll let him get a little more into his background when he pops on in a couple minutes. And if you've been with us before, you know that we typically focus on something new in the world of banking, particularly bank compliance. It's dear to my heart. But we also like to cover other new developments that are of interest to the banking community, such as when the FFIEC was retiring their cybersecurity assessment tool, the CAT, or when the One Big Beautiful Bill included tax provisions that were of interest to banks. We had a couple of our tax folks come on and talk to you about that. So we're going to kind of go down that road again today and give you a break from listening to me for most of an hour so that we can discuss a few accounting standards updates that may be of interest to bankers. Those of you who know me, you know that I'll belly up and talk all night long about TRID, CRA, fair lending, EFT, BSA, on and on and on. But you also know that when you say, hey, Brad, you work for an accounting firm. Can I run an accounting question by you? I'll quickly defer to someone much wiser than I when it comes to those things. And today, that someone is Jon. I got it. Cut to the chase, get to the housekeeping items before we get too far into this. So the first question we always receive is whether you'll receive a copy of the handouts. And the answer to that is yes. You'll receive the slides with the post-webinar materials. Those will be sent via email, and we'll also include a link to the recording and some other relevant information. That email should come out within the next few days, hopefully by the end of the week. If not, surely it should be sometime next week. And so I'll turn it over to Jon shortly, but do want to make one final housekeeping note that with the number of participants we have today, we won't be unmuting you to ask questions, but do welcome your questions in the Q&A feature. So please place those questions in the Q&A feature and not the chat. You should see that at the bottom of your screen, Q&A. If you don't, click the More button, and Q&A should be an option there. If you have a tech issue, throw that in the chat. So questions in the Q&A, tech issues in the chat. And then at the end of Jon's prepared remarks for each of the standards, I'll jump in. I'll try to act like I know what I'm talking about and pose at least some of your questions to Jon. So with that, I'll hand things off to Jon. Mr. Waitukaitis, the floor is all yours.
All right. Welcome, everyone. As Brad mentioned, my name is Jon Waitukaitis, and I'm a partner with Anders. You are correct, sir. It's been over 20 years, and I'm leading the assurance side of our banking practice. So you can see the agenda here. I'm going to give an update on significant accounting standards issued during 2025, and also one issued in 2023 that is now applicable in this current year, 26. I chose ones that I thought were applicable to banking, or at least ancillary, maybe not directly applicable, but ancillary in some certain circumstances. So none of these I would consider to be huge overhauls, but they do offer targeted improvements to existing guidance, or in the case of the government grant standard, they offer new guidance on transactions where there was previously none. So, I don't know that we're going to take the whole time today, in which case you can head out earlier to lunch, so you're welcome. But in any event, we'll go ahead and dive in. So the first standard we'll cover today, like I said, is ASU 2025-10, relates to government grants. So this standard was issued because GAAP previously had no authoritative guidance for business entities receiving government grants. As you can imagine, this really came to light during COVID when you had these types of grants with no related guidance. And so companies were forced to adopt analogous guidance from other standard setting bodies such as IFRS. The standard establishes a comprehensive framework in topic 832, which is largely aligned with international standards IAS 20 and applies broadly to for-profit entities receiving government grants outside the scope of income taxes or revenue recognition. It does apply to non-exchange government grants, but also excludes a laundry list of certain transactions. And I'm not going to get into all those here, but I just wanted to point out that there is specific scoping out of certain transactions in the standard. Okay, so the overall principle of the new standard is that a government grant is recognized in earnings in the same period or periods that the cost for which the grant was intended to compensate are recognized. In other words, the timing of the recognition of the grant income should generally match the timing of the recognition of the related expenses. A government grant, however, cannot be recognized until it is probable that both of the following conditions will occur. One, the company will comply with the conditions attached to the grant, and two, that the grant will actually be received. Additionally, a grant receivable or grant income cannot be recognized before the company begins to incur the related costs. So I mentioned the conditions included here must be probable, and so it makes sense to define that, and GAAP does indeed define the term probable as the future event or events are likely to occur. This is generally considered a likelihood of 75% or greater. And to assess whether the probable threshold is met, the company's going to need to evaluate all of the conditions for receiving the grant, as well as any ongoing requirements or conditions for retaining the grant. The standard does differentiate between a grant related to an asset and a grant related to income, which is going to be based on the purpose and conditions of the grant. The standard defines a grant related to an asset as a government grant or part of a government grant that is conditioned on the purchase, construction, or acquisition of an asset. So, think long-lived assets here. A grant related to an asset is recognized on the balance sheet once the probable threshold is met and those related costs are incurred. The standard allows two alternative accounting policies for recognition. The first being a deferred income approach. In this scenario, the grant is initially recorded as deferred income and then subsequently recognized in earnings on a systematic and rational basis over the periods the expenses related to the asset are recognized. So, for instance, the asset as the asset is depreciated or when the asset is otherwise sold or impaired. There is also a cost accumulation approach. In this scenario, the grant is reflected as an adjustment, generally a reduction to the cost basis of the asset's carrying amount. Under this approach, the grant income is implicitly recognized through reduced depreciation expense or a lower cost basis upon impairment or sale of the asset. So in other words, there is no separate recognition of grant income here. The standard does provide specific guidance for a grant related to the acquisition of a non-depreciable tangible asset, so think land. So when a company elects the deferred income approach, since there is no future depreciation expense related to the asset, in this situation, company would subsequently recognize the grant and earnings on a systematic and rational basis over the periods in which it incurs the costs to which the grant relates, which is a recurring theme throughout the standard. In regard to a grant related to income, the standard defines it as a government grant or part of a government grant other than a grant related to an asset. So for example, here, this would be a grant that reimburses an entity for operating expenses. Again, once that probable threshold is met, a grant related to income is recognized in earnings on a systematic and rational basis over the periods the related costs are recognized as expenses. In this case, the related costs are those in which the grant is intended to compensate. If the grant is intended to compensate for expenses or losses already incurred, or to provide immediate financial support without contemplation of any related cost, the grant is recognized in earnings in the period that probable threshold is met. The standard also covers forgivable loans, the PPP loans. It specifies that a forgivable loan from a government is treated as a government grant if it is probable the company will meet the terms for forgiveness. This is because a loan that is expected to be forgiven is considered economically equivalent to a cash grant. So the recognition of a grant in the form of a forgivable loan also depends on whether it is a grant related to an asset or that related to income. Companies should continue to reevaluate the probability of meeting the terms for forgiveness each reporting period until the loan is forgiven. Okay, the standard does allow a couple alternative accounting policies for financial statement presentation, depending on the type of grant and the accounting policies elected for recognition. As summarized on this slide, this is the balance sheet. I have the next one will be for the income statement, but as you can see, it's primarily presented as deferred income liability or as an adjustment to the cost basis of the specified asset. And then here is the income statement presentation. And as you see, it is primarily presented other income or a reduction of expenses. The standard does come with new disclosure requirements. So for grants related to an asset under the cost accumulation approach, you would disclose the line items on the balance sheet that are affected and the related amounts and the useful life of any related depreciable or amortizable asset. For grants related to an asset under the deferred income approach and grants related to income, you would disclose the line items on the balance sheet and income statement that are affected by the grant and the related amounts in the current reporting period. And then finally, for grants of tangible non-monetary assets, you would disclose fair value in the period the grant is recognized on the balance sheet. Okay, effective date and transition. So this is still a few years out, effective for annual periods ending after December 15th, 2029. Early adoption is permitted. If you are currently applying IAS 20 by analogy, you may see limited income statement impact, but documentation, policy elections, and disclosures will need to be formalized under the new standard. So under the standard, you have several transition methods permitted. The first is a modified prospective approach by applying the guidance to grants either entered into on or after the effective date or not complete as of the effective date. There is also a modified retrospective basis by applying the guidance to grants either entered into on or after the beginning of the earliest period presented or to not complete as of the earliest period presented. In these cases, all prior period results would be restated through a cumulative effect adjustment to the opening balance of retained earnings as of the beginning of the earliest period presented. And then finally, there is a full retrospective election to where you are going to restate both years presented with a cumulative effect adjustment on the to retain earnings on the earliest period presented. Okay, so that covers the first standard. Well, Brad, do you have any questions?
All right. So no, there aren't any questions in the Q&A right now. Let me check real quick and see if somebody dropped one in the chat. And they have not. So if you've got any questions on government grants, go ahead and throw those in and we'll ask them real quick, or we can get them next time around. Kind of to prime the pump, maybe. I know that when John and I were talking beforehand, he said a common question we've received is on whether or not this standard applies to ERC credits. So John, do you want to talk about that for a second?
Yeah, no, it would. And that would be under the income approach. Unless you're in a subsequent year where you would recognize that in other income, otherwise it would be a reduction of those related expenses. But yes, it does apply.
All right, very good. Well, still no questions, so I think we're good to go ahead and jump into purchase loans.
Okay, so this is standard ASU 2025-08 and deals with credit losses on purchase loans. So this standard addresses one of the most criticized aspects of the CECL standard, which is the day one credit loss expense on acquired loans that were not classified as purchase credit deteriorated assets, or PCD assets. Historically, CECL required entities to differentiate between two categories of purchased financial assets. The first being PCD assets, which follows the gross-up method, and non-PCD assets, and now those are the ones that require that day one credit loss expense. So stakeholders widely noted that this dual model system created unnecessary complexity, subjectivity, and a lack of comparability. And they also pointed out that recognizing a day one loss on non-PCD assets could double count expected credit losses already reflected in fair value. So the industry strongly encouraged a more intuitive and consistent approach, and we got it. So although the FASB decided not to apply the gross-up method to all non-PCD loans, it did expand the method to a subset of non-PCD loans, which are now called purchased seasoned loans. Non-PCD loans must meet seasoning criteria to be considered purchase seasoned loans, and to do so, they must meet either of the following criteria. The first one is simple: that a loan was acquired in a business combination using the acquisition method. Or two, the loan was acquired outside of a business combination, but meets both of the following criteria. So the loan was obtained more than 90 days after its origination date, and the acquirer was not involved in the loan's origination. So the initial recognition of a purchased seasoned loan is now the same for PCD loans. So you're going to gross up the amortized cost basis of the loan for the estimate of credit losses on the loan at acquisition date. That day one allowance is established without any income statement effect. Although the initial accounting for purchase season loans and PCD loans is the same, there are some narrow differences in subsequent measurement. The first being for purchased season loans, if a method other than a discounted cash flow method is used, an accounting policy election permits subsequent measurement of expected credit losses to be based on the amortized cost instead of the unpaid principal at each balance sheet date after the acquisition date. In contrast, if a method other than a discounted cash flow method is used for PCD loans, the initial and subsequent measurement of expected credit losses is based on unpaid principal balance. The second is there is incremental guidance on recognizing expected recoveries that applies to PCD assets, but not to purchased season loans. And the third is purchased season loans are not subject to specific guidance for PCD loans that indicates recognition of income is dependent on having a reasonable expectation about the amounts expected to be collected. So one thing to note here is that because of the narrow subsequent measurement differences between purchase season loans and PCD assets, if you do want to combine those assets in the same pool for measurement of expected credit losses through your CECL model, you should consider to the extent to which these differences may be material. Just real quick, wanted to point out the ASE does not change, or the ASU does not change the accounting for originated loans, PCD assets, or other acquired assets outside the purchase season loan definition. Another quick note here is that purchase season loans do not include credit cards, debt securities, or trade receivables arising from transactions accounted for under ASC 606. However, revolving consumer loans, such as home equity lines of credit, do need to be evaluated to determine if they are purchased seasoned loans. The ASU's guidance is effective for annual reporting periods beginning after December 15th, 2026, including interim reporting periods, and you must apply this prospectively. You may early adopt the guidance in an interim or annual period in which financial statements have not yet been issued or made available for issuance. And an entity that adopts the amendments in this interim reporting period may apply them as of the beginning of that interim reporting period or the beginning of the annual reporting period that includes that interim reporting period. Some implications to consider for your institution in regards to this standard. These are just going to be some quick hitters, but for due diligence and acquisition processes, you'll need clear procedures to determine whether the acquirer participated in origination, and likewise, loan file documentation will likely require some enhancements. For modeling, gross up calculations may require changes to the CECL models or other data inputs, and also interest income models may need adjustments due to the amortized cost basis changes. From an M&A strategy perspective, business combinations now will automatically classify all non-PC loans as seasoned, and this can impact acquisition modeling. And finally, on financial statement presentation, you can expect smoother earning trends under the new model, and improved comparability across institutions is likely to be a positive for users of financial statements. So Brad, I don't know if we have any questions on purchase season loans.
We do not, so I think it's okay to move on to internal use software.
All right. Well, as you've already said, we're talking about ASU update 2025-06 internal use software. So this standard introduces targeted improvements to the accounting for internal use software, and represents really a meaningful modernization of software cost accounting. It's going to modernize how entities account for internal use software cost, recognizing that most software today is developed iteratively rather than through linear stages. So the standard is going to remove all references to development stages and replaces them with a single principle-based capitalization threshold. FASB received extensive stakeholder feedback that the internal use software guide no longer reflects today's development practices. Much of that model was built around the sequential waterfall approach to development, which assumed projects move linearly from planning to development to implementation. But over the past decade, the dominant approach has shifted to agile and iterative methodologies. which involve continuous development, prototyping, and refinement. This mismatch created challenges for preparers and determining to be capitalizing use software costs. Stakeholders also emphasized that the software cost model should align more closely with economic substance and remain operable, regardless of whether an entity uses waterfall, agile, or hybrid methodologies. Okay. The ASU applies to all entities that incur internal use software costs. So this includes internal apps, internal systems, automation tools, website development cost. It does not change the accounting for software intended to be sold, leased, or marketed to customers under Topic 985. And it also does not change the accounting for software licenses accounted for under external use guidance. As I mentioned, one of the most significant amendments is the elimination of all references to traditional development stages. So previously, entities capitalized software cost only after exiting the preliminary project stage. This framework no longer aligns with agile or non-linear development. So by removing the stage-based criteria, the board aims to create a principles-based approach that applies regardless of the project structure. Under the standard, capitalization begins only when both of the following conditions are met. So the first is management authorizes and commits to funding the project, and two, it is probable that the project will be completed and the software will be used for its intended purpose. This is known as the probable to complete threshold. This threshold was actually present in prior guidance, but it is now the primary trigger for capitalization. The ASU provides new examples and clarifications for when assessing whether a project meets this probable to complete requirement. So, what do these criteria really mean, and what are some examples of satisfying them? So for the first criteria, this could include management's approval of funding for the internal development of an application. It could include the execution of a contract with a third party to develop software, or it could include the execution of a contract to simply obtain software from a third party. And then in regards to the second criteria, the probable to complete threshold requires an entity to assess whether there is significant uncertainty associated with the development activities of the software. This is referred to as significant development uncertainty. And that exists if either of the following factors are present. So one, the software being developed has technological innovations or novel, unique, or unproven functions or features, and the uncertainty related to those technological innovations, functions, or features, if identified, has not been resolved through coding and testing. And then the second factor would be the significant performance requirements of the software have not been identified, or the identified significant performance requirements continue to be substantially revised. So when significant development uncertainty does exist, the probable to complete threshold is not yet met, and capitalizing software cost of a project would not yet be appropriate. Once an entity resolves the matter causing significant development uncertainty, it should begin capitalizing software cost if all other capitalization requirements are met. So this is going to require more judgment and stronger internal controls, particularly with entities with decentralized or agile development environments. The standard does eliminate section ASC 350-50. This was the prior guidance on website development costs. Any of that relevant content has been relocated to 350-40 and supplemented with updated examples. So this means you no longer need to maintain a separate accounting model for website development, and the treatment of web-based tools now aligns with general internal use software development. So what has not changed? The ASU does preserve several long-standing principles. The first being the types of cost eligible for capitalization do remain the same, and that is training, data migration, and maintenance must still be expensed. Capitalization ceases once the software is substantially complete and ready for use. And again, external use software guidance remains unchanged. So the standard clarifies that all capitalized internal use software costs must follow the disclosure requirements of ASC 360-10, which is the PP&E standard. And that applies regardless of where those assets appear in the financial statements, improving transparency and alignment of disclosures with other long-lived assets. Effective date and transition. The amendments are effective for fiscal years beginning after December 15th, 2027, including interim periods within those years. You may apply the amendments in this update using any of the following approaches. There is a prospective method. So you apply to new software costs incurred as of the beginning of the period of adoption for all projects, including in-process projects. There is a modified option where you basically apply new software costs incurred for all projects, but you would de-recognize any capitalized costs that don't meet the new guidance through cumulative effect adjustment to the opening balance of retained earnings as of the date of adoption. And then there is the full retrospective where you recast comparative periods and recognize a cumulative effect adjustment to the opening balance of retained earnings as of the beginning of the first period presented. And early adoption is permitted. Some things to think about in regards to this standard, because the ASU eliminates stage-based criteria, entities are going to have to exercise more judgment in determining whether development uncertainty is resolved and when capitalization should begin. You're going to have a need for better documentation. So management authorization and that probable to complete assessment must be clearly documented to support capitalization decisions. And then agile teams who often iterate rapidly across design, development, and testing. This ASU allows the accounting to better mirror those practices, but is also going to require disciplined tracking of these types of cost across multiple teams. And then just impact on budgeting and forecasting. Capitalization patterns may shift earlier or later, depending on how you define readiness and your certainty thresholds. Okay. I don't know, Brad, do we have any questions on internally used software?
We do not at this point. So remember, if you have any questions, feel free to throw them in the Q&A. I know one thing we talked about beforehand is whether this standard would apply to a third-party success fee to negotiate a new core system. So if you want to talk a little bit about that.
Yeah, so this actually does not apply to that common transaction. And the reason being is that first of all, you don't need to hire a third party to obtain the contract, and you are hiring them to negotiate the fee. Once that fee is negotiated, they have satisfied their obligations under their contract with you. And so it is a period expense in the year that that condition is met.
All right, very good.
So, okay. Well, then we'll move on to our next standard, and that's ASU 2025-03, and that relates to variable interest entities in a business combination. So this standard addresses inconsistencies in how the accounting acquirer is identified when a variable interest entity is involved in a business combination. So previously, the primary beneficiary was always deemed the accounting acquirer. This rule is now eliminated for equity exchange business combinations. For the standard, the guidance in ASE 805 required that when the legal acquiree in a business combination was a VIE, the primary beneficiary was always treated as the accounting acquirer. This created inconsistencies because when the acquiree was not a VIE, entities were required to assess a series of factors such as voting rights, governance, senior leadership, and other elements to determine which party truly controlled the combined entity. As a result, two economically similar transactions could be accounted for very differently, depending solely on whether the target met the definition of a VIE. Stakeholders expressed concerns about these unintuitive, non-comparable outcomes. And just real quick, this standard does remove the default rule that the primary beneficiary of a VIE must always be the accounting acquirer. Under the new guidance, when a business combination is affected primarily through the exchange of equity interest, entities must evaluate the same set of factors used for non-VIE acquisitions. And this includes the factors listed in ASC 805 and is included on this slide for your reference, related relative voting rights, existence of large minority voting interests, compositions of the governing body, compositions of senior management, terms of the exchange, and the relative size of the combining entities. So by applying these factors, an entity may conclude that the legal acquiree, even if it is a VIE, is actually the accounting acquirer. And this can result in what we would call a reverse acquisition. This change significantly improves comparability by aligning the assessment for VIE and non-VIE acquisitions. So why does this matter? This determination is important because the accounting acquirer sets the measurement basis for the business combination. The acquirer measures the acquired entity's assets and liabilities at fair value, while its own assets and liabilities remain at carrying amounts. So this potentially could impact post-combination financial statements, net income, future depreciation and amortization, and potential impairment analyses. Under the prior rules, VIE acquisitions could cause entities to unintentionally create a new basis of accounting, sometimes resulting in outcomes that differ dramatically from economically similar non-VIE transactions. The standard addresses those concerns by removing the automatic designation of the primary beneficiary. So this standard is going to apply to all business combinations where the legal acquiree is a VIE that meets the definition of a business, and the transaction is primarily affected through the exchange of equity interest. For VIEs that are not businesses, the prior rules continue to apply. Effective dates and transition. The guidance applies prospectively. Or because the guidance applies prospectively, transaction structuring and accounting conclusions may differ significantly depending on the timing. And it is effective for annual periods beginning after December 15th, 2026, including interim periods within those fiscal years. Early adoption is permitted for any interim or annual period for which financial statements have not yet been issued or made available for issuance. Like I said, application is prospective, meaning it applies to business combinations occurring on or after the date of adoptions, and you are not required to restate any prior transactions. Brad, you got any questions on VIEs?
We do not. I think we're good to keep on moving.
Okay. So this is the last ASU I will touch on today, and this is 2023-09 and is related to income tax disclosures. So this standard is going to significantly expand income tax disclosures in the response to investor demand for transparency about how tax risks tax planning, and operational opportunities in an entity's worldwide operations affect the effective tax rate and future cash flows. Importantly, this ASU does not change recognition or measurement. This is simply disclosure, and it applies to all entities subject to income tax disclosures under Topic 740, which is income taxes. Public business entities are going to have much more extensive quantitative disclosure requirements, while private entities generally are going to have more qualitative requirements. And for today's purpose, we are focused only on private entity disclosures. So the most significant change in the standard is that it now requires qualitative discussion of the nature and effect of significant differences between the statutory income tax rate and the effective tax rate by specific categories of reconciling items and by individual jurisdictions. The standard identifies specific categories of reconciling items used for this purpose, and they include items such as state and local income taxes, foreign tax effects, changes in tax laws or rates, cross-border tax effects, tax credits, valuation allowance changes, and any non-taxable or non-deductible items. The objective of this reconciliation is to provide information, principally the nature and magnitude, about what causes the differences between the expected tax and the reported income tax, which is particularly relevant when an entity operates in multiple jurisdictions. So, for example, the qualitative discussion about the effect of a specific category or individual jurisdiction may simply indicate whether that item increases or decreases the effective tax rate. You do not need to disclose specific amounts. Again, this is for private entities only. While non-public entities are not required to disclose a tabular rate reconciliation as is required for public entities, you may elect to do so. I don't recommend that. But in those situations, you would need to follow all of the rate reconciliation guidance for public entities to prevent their disclosures from being misleading. So you can't pick and choose, essentially, is what they're saying here. And I did want to mention when evaluating all this, you should consider materiality. FASB actually considered whether to provide specific guidance on materiality in this standard, but given the existing guidance stating that the provisions of the codification need not be applied to immaterial items, the board decided it was not necessary to do so. And then they did acknowledge that exercising judgment is expected when determining whether a reconciling item is material. The standard also requires enhanced disclosures on income taxes paid. So both public and private, you must disclose income taxes paid, net of refunds, disaggregated in two ways. The first is by federal, state, and foreign tax, and then two by individual jurisdictions where taxes paid represent 5% or more of the total income taxes paid. So this is going to be one of the most impactful changes, as many companies historically disclosed only aggregate totals. So for this purpose, each domestic or foreign, federal, or state jurisdiction is considered an individual jurisdiction. If an entity has a separate tax-paying component, filing separate tax returns with an individual taxing authority, then all amounts paid by those various tax-paying components to each tax authority is combined when determining, one, the amounts paid to an individual jurisdiction, and two, whether that amount meets that disclosure threshold I mentioned earlier, that 5%. All entities are required under this standard to disclose the following amounts for annual reporting periods presented. I'm sorry, for each annual reporting period presented. The first being pre-tax income or loss from continuing operations broken out by domestic and foreign, and two, income tax expense or benefit from continuing operations broken out between domestic federal, domestic state, and foreign. These items were previously optional or inconsistently disclosed. Under this standard, they are required. I would point out that when all of an entity's pre-tax income from continuing operations is from one country, no disaggregation of the income is necessary. However, if it is not otherwise evident from the financial statement disclosures, you should consider disclosing that all of its pre-tax income from continuing operations is from a single country and to name that country. Similarly, if all the entity's income tax expense from continuing operations is domestic federal, domestic state, or foreign, no disaggregation is necessary. However, we believe the entity should disclose the applicable grouping from which it came. Effective dates and transition for non-publics. This is applicable now in 2026. Early adoption is permitted, but we're behind that stage. The ASU also applies on a prospective basis to annual financial statements for periods beginning after the effective date. You may retrospective application in all periods is permitted as well. So that would conclude my presentation today and my prepared remarks. Brad, I don't know if we had any questions on the income tax standard.
We do not, but I know a lot of times we get questions afterwards and people feel more comfortable reaching out and just talking to us one-on-one. So with that, you've got John's information um, here that you can give him a call, shoot him an email. Either one of those works just fine. So thanks again, John, for all that great information. Even though sometimes you use acronyms are a little bit foreign to me, I think I do always learn something when I sit down on one of your presentations. Probable is 75%.
There we go.
So wonderful. And thanks also to all of you who joined us today. We truly appreciate that. We hope you'll join us again on June 24th for our next webinar. That likely will focus on something related to compliance. We got a few ideas brewing right now. One of them is the FDIC recently published their most common compliance violations of 2025. So always good to dig in and to see what they're focusing on. Earlier this week, FinCEN published a proposed BSA, AML, CFT. They're getting too many acronyms for BSA these days. But this is a new proposed rule that's trying to further FinCEN's efforts to modernize both the regulatory and supervisory framework that surround your anti-money laundering programs. And then also we fully expect something more to come out on 1071 between now and then. So we should have plenty to talk about on compliance come June. And, we sure hope to see you then. John, I don't know if you have any other closing remarks you'd like to leave everyone with.
No, not really. I just thanks you all for attending and allowing me to give you this update. Appreciate it. And we'll revisit this again when FASB has inevitably issued several more standards.
You'll be a recurring guest on the webinar.
Yeah.
That would be great. All right. So yeah, there's John's information. I think we flip it forward. You'll see mine. If there's anything, compliance, loan review that you'd like to talk about, that'll be in the webinar or in the materials that come out post webinar. Again, we greatly appreciate you being with us today. And I believe that wraps things up. So thank you very much, and we will see you next time.